Hello and welcome back to the Prodi Academy YouTube channel. I'm Michelle, and in today's video we're going to be discussing the number one secret in accounting and how this helps you understand your financials. So as accountants to small business owners, something we often hear from new clients is, I don't understand my accounting records and I really don't have the knowledge to understand my financials. And our response is always, yes, we can help, and that is what we're here to do. We're here to take that burden away from you. And today we're going to help a little bit more and give you or let you in on the number one accounting secret. And by applying this should go a long way in helping you understand your financials. So with that said, let's jump straight in. So what is the secret that I'm referring to? Well, it is known as the accounting equation. And the accounting equation is the most basic principle when it comes to accounting. It's the fundamental element of the balance sheet and sets up the foundation of what is known as the double entry accounting system. So in other words, this very tiny equation is kind of a big deal. So what is the equation? Well, the equation reads as assets is equal to liabilities plus members or shareholders' equity. So with that in mind, let's delve a bit further in and unpack the equation. Per Investopedia, double entry is a fundamental concept underlying present-day bookkeeping and accounting, and it states that every financial transaction has equal and opposite effects in at least two different accounts. So what this means is an accounting entry essentially has two sides, a debit side, which is on the left-hand side, and the credit side, which is on the right-hand side. Now, for every transaction that you have or that you post or that is processed in your books when it comes to your accounting records, the left-hand side and the right-hand side need to be in balance. So they need to equal when you have completed the processing of the transaction. And if the left-hand side and the right-hand side don't match, then we have a problem. So if we look at the balance sheet, now if we step back and take a look at our balance sheet, this is essentially the accounting equation. You have your assets or your total assets, followed by your liabilities, and then your equity total. And this always needs to balance. Now, in order for us to better understand or to help our understanding in terms of what goes under which section, we're just going to chat about what some of the high-level examples are in each category. So starting with assets, your assets will comprise things such as cash, accounts receivable, being amounts owed to you by customers when you sell to them on credit. You'd also have things like inventory, property, plant, and equipment, as well as investments in other entities. We then move on to the liability section, which is anything that you essentially owe. Things here will include accounts payable, which is amounts that you owe to vendors if you've purchased from them on credit. You would also have loans from banks here or third parties that have provided you with funding. And you would also have other short-term loan balances or short-term credit balances, such as credit cards that you might have. And then, of course, the final component is our shareholders or members' equity, which is your original investment into the business. It also includes items like distributions, as well as your net income or loss, which is the sum of all your income less your expenses for the period, as well as your retained earnings or your retained income, which is the cumulative net income or loss that your business has generated since its inception up until the previous or up until the end of the previous financial year. Now, if we go back to the format of the balance sheet, what we are looking for when we look at the balance sheet, other than it balancing, because as I mentioned already, it needs to balance, we also want to see that our assets exceed our liabilities. So in other words, you own more than what you owe. This should mean your equity is positive, so your business has a value. You also want to see that your net income is positive, so your business is making a profit, and that your cash flow is positive. Now, you won't necessarily, or you can't necessarily see this on the face of the balance sheet, but it is an important point to keep an eye on. Now, we might be asking, how does the accounting equation help me understand these financials or help me understand the balance sheet a bit easier? And with that said, we're going to look at a couple of examples where we apply our accounting equation and see how this goes. we take a look at the sale of inventory, or where we have provided a service, we have created income, and this would therefore improve our profit and loss, and it would increase our equity. It would also increase our assets because we've either received the cash immediately, in which case it increases our bank balance, or we have a promise to pay from the customer. We have sold to them on credit, so we have an amount that is receivable from them that they will settle down the line. It would also have a positive impact on our cash flow because of the funds that would be coming in. The next example that we'll look at is when we pay a utility bill. Now, this is seen as an expense, so it will decrease your profit and loss and therefore decrease your equity. It will also decrease your assets because this money has now come out of your bank balance, so your bank balance has been reduced. So this would then have a negative effect on your profit and loss, on your balance sheet, and on your cash flow. And you could have it where if you don't pay for it immediately and you're going to settle it later, they've offered it to you on credit, you would then create a liability, which would be, instead of having the reduction in the asset, if you paid the cash immediately. Though your expenses do have a negative impact on equity, they are necessary, and the goal is to make sure that your income is always in excess of your expenses and that you are able to show a profit. The third example is where we've purchased an asset, where we've purchased inventory. So when we purchase inventory, we can either do so by paying for it upfront with cash, in which case we would have an increase in our assets because of the inventory that we've purchased, and a decrease in our assets because of the cash that has gone out of our bank account. Alternatively, if we purchase it on credit, we could have an increase in inventory asset as well as an increase in our liability because we now have an obligation to pay for that inventory down the line. So overall, this transaction would have a net effect of 0 on your equity, but it would eventually have a negative effect on your cash flow. Now, it's important to note that purchasing assets is important for the business, as it can contribute to the business's ability to make a profit, but it's also a good way in which to spend or make use of excess cash. And the final example we'll look at is that of obtaining a loan from the bank. Now, at times your business may need to obtain additional finance or some assistance, whether it be for additional investments, in which case you would be approaching the bank or a third party in order to provide the funds. Now, the loan would bring in cash, so straight off the bat, this transaction would result in an increase in our assets because our bank balance has improved, but it would also create a liability because we now have the obligation to pay the bank back at a later stage. So this transaction would have a net effect of 0 on our equity, but it would have a positive inflow of, or a positive effect on our cash flow because of the inflow of cash. It is important here, again, when we're looking at liabilities, that when we look at financing, if the debt is used strategically to develop and to grow the business, the benefits of getting the debt on board would outweigh the negative impact on your profit and your equity down the line, because of course with financing comes our finance charges, so there would be expenses attached to getting this financing on board. Through these examples, we can now see how the accounting equation works and how it can give us a better understanding of what's going on with our business, as well as what's going on with our financial statements. The key takeaways should be that every transaction should be in balance, and when we say it should be in balance, we mean the debit sides should equal the credit sides. It should always be in balance. And the next takeaway is we can absolutely apply the accounting equation, being our assets is equal to liabilities plus equity, to absolutely any transaction that arises in the business, and the underlying principle will always remain the same. As always, we trust you found this video insightful, and should you have any thoughts, comments, or suggestions for future content that you'd like to see, please feel free to pop it in the comment section below. Please also join us on our social media platforms such as LinkedIn and Facebook, or at our website at proteafinancial.com. Protea Academy, striving to achieve better accounting for everyone.